Welcome to episode 67 of the 5-Minute Investor, the podcast where we break down stocks at the heart of two stories shaping your investing week. I'm Trevor Abbas.
And I'm Jonathan Brown. Each week we bring one stock, one headline, and one reason investors should care.
This week, AI is once again top of mind for investors who are being asked to balance concerns about hundreds of billions in mega-cap tech company spending with the fact that these companies are posting solid earnings overall. The question of the hour then becomes, which are the most promising players excelling amidst a crowd of also-rans? In this episode, we have two notable names for you to add to your watch list, and John kicks things off in the large-cap space.
Trevor, let's talk about Micron Technology Incorporated. It's basically a household name, if your house is full of nerds. It trades on the NASDAQ with the ticker symbol MU.
All right, John, what is the story behind Micron?
Well, Micron is a semiconductor company that produces memory chips like DRAM, critical components that store and process data in everything from smartphones to AI data centers. It's central to the current memory supply crunch that we're talking about because AI systems require massive amounts of high-performance memory, and demand is far outpacing what the industry can produce. That allows Micron to benefit from higher prices, also surging revenue, and strong pricing power, even as it struggles to meet all this customer demand.
I've heard about the rally among tech stocks right now, John, but where does Micro fit into this surge?
Well, MU stock, last I saw, was up more than 300% since the year began, and it's risen more than 800% as of this recording since this time last year. That growth also brings a hefty price tag, though. One share in June 2025 was worth $120 US, but now that stock has risen to over $1,200. The surge is also being felt on the consumer side like us. I just wrote an article on Stockhouse about one of Micron's competitors, SanDisk. They're releasing a storage drive for PlayStation that costs, can you believe this, $3,000 US, which is more than 3 times what a PlayStation Pro is even worth. That's just one outrageous example. There are many stories of people trying to buy storage during the shortage, and even all the tech companies are feeling the struggle.
All right, but how has an industry giant like Micron handled this struggle?
Well, it seems like Micron is both, benefiting from it and financially, and is also strained operationally at the same time. Micron's CFO admitted to investors that they can't keep up with the demand, and they are sold out in many respects well into next year, all thanks to the evolving demands from AI. So I've been covering this company for quite a while in Stockhouse, and quarter after quarter, they keep breaking their own records and earning higher revenues than what they predicted in the prior outlooks. But I've also noticed their operating costs are also exceeding their own expectations time and time again. So we will see how long this rally lasts. Could just as soon pay higher and higher dividends or come off the rails. Should also mention Micron's market cap is over $1 trillion US. So you can look at this as a benchmark for the tech industry, and then even the NASDAQ itself is faring. You can apply this to a more reasonable buying opportunity like what Trevor's going to tell us about.
That's right, John. My AI stock for this episode is HIVE Digital Technologies, ticker HIVE on the TSX and the NASDAQ, market cap 1.58 billion Canadian. And the company is among the first publicly traded issuers to mine cryptocurrency using clean energy. Over the past few years, however, it has expanded into building and operating data centers across Canada, Sweden, and Paraguay, squarely aligning itself with a global AI market on track for exponential growth into the next decade.
Okay, so Trevor, help me reconcile a crypto company with a transition towards computing power here. What's the through line? Why does it make economic sense? What's the goal here?
Well, first things first, John, you need computing power to mine Bitcoin. And HIVE was sitting on a great deal of it when crypto was its lone concern. Secondly, the company quickly noticed, as have many other crypto companies, that making your name in the accumulation of extremely volatile assets will entail some tough times every now and then, as crypto's numerous winters clearly demonstrate. So, once ChatGPT ignited the global push to integrate AI across industries, and with it the demand for compute power to train AI models, HIVE saw the opportunity to diversify away from crypto by putting its megawatts towards high-performance computing. The company will have 540 megawatts operational by the end of 2026, up from 120 in 2021, and is on the lookout to expand this figure through strategic acquisitions and partnerships.
Okay, that's seeing a bigger picture. But now I'm wondering, how has this diversification worked out for the company, in terms of the financial results?
Though it's still early days, given that in fiscal 2026, Hive collected 278.3 million US in digital currency mining revenue and only 19.5 million in high-performance computing revenue, the HPC figure is up by 94% year over year, leading to significant improvements in both gross operating margins and adjusted EBITDA. This dynamic, in my opinion, grants investors a limited but promising sense of how the compute division might help free Hive from the moody nature of the crypto market.
I see. So is the company's compute division on track, in your opinion, to do more of the heavy lifting in terms of revenue generation?
Absolutely, it is. A few recent milestones to consider are a $220 million deal to run AI models in a Bell data center in BC, an agreement to build one of Canada's largest AI gigafactories to be located in Toronto, as well as a letter of intent to lease its 32-megawatt Swedish data center for up to the next decade. All of this within the past 2 months. The company has even stated that deals in place put high-performance computing annual recurring revenue on pace to grow from 35 million US contracted at fiscal year end to 660 million by year end 2028, or more than double what the company earned from crypto over the past year.
Okay, now I'm seeing it. So with a path towards a more stable future ahead of it, built upon recurring as opposed to speculative revenue, what's the stock been up to as of late?
It's actually up by about 112% year over year, John, almost 4 times the TSX's 31% effort over the period, at a time when crypto returns, to put it charitably, have been less than compelling. All things being equal, investors should then continue to be rewarded as the company strengthens its ability to withstand crypto volatility with earnings elsewhere on the income statement.
As always, you can find links to the articles from today's episode in the show notes and more investing insights on stockhouse.com.
And you can find the 5-Minute Investor on Spotify, YouTube, iHeartRadio, Stockhouse, or wherever finer podcasts are found. This podcast is produced in partnership with Micron Technology Inc. and HIVE Digital Technologies Ltd. and is intended for informational purposes only. For full disclaimer information, please visit stockhouse.com/legal/disclaimer.